Let's get right into it. Welcome to this explainer. Today, we are pulling back the curtain on something Wall Street doesn't exactly advertise: how public companies legally manipulate their financial numbers. We're going to look past the PR and examine the raw mathematics and the corporate incentives that engineer market perception right beneath the surface. So, think about this. What if the financial performance you see in the headlines is just an illusion? As investors, we constantly place our trust in quarterly profits, revenue growth, and management commentary. But the much deeper and frankly more important question is, how can a corporate entity make its financial reality look substantially better without technically breaking a single law? Well, that brings us to part one, the earnings illusion. To really understand why this happens, you have to consider the immense, almost crushing pressure that management faces to maintain a stable stock price. Now, it is absolutely crucial to distinguish here between outright fraud and legal accounting flexibility, right? Accounting isn't some perfectly objective reality. It's literally a set of assumptions. So companies manage perception by legally adjusting things. They might change depreciation methods, say shifting from accelerated to straight line just to lower immediate costs. Or they might tweak the timing of revenue recognition, or shift how certain expenses are classified. The result? Profit suddenly looks a whole lot smoother, even if the underlying business reality is actually temporarily deteriorating. A company can logically delay recognizing certain expenses or maybe book revenue just a little bit earlier to hit that crucial quarterly target. Now, this flexibility doesn't automatically mean the business is failing, but it absolutely means that smart investors, that's us, must strip away those shiny headline numbers to find the actual hard cash flow. Moving on to part two, EBITDA versus real profit. Okay, EBITDA. Earnings before interest, taxes, depreciation, and amortization. It is literally Wall Street's favorite metric. But while management heavily promotes this adjusted EBITDA to project a really strong operational performance, stripping away that acronym reveals exactly what they're conveniently leaving out of the narrative. Because let's be real, EBITDA willfully ignores massive, unavoidable expenses. We're talking interest obligations, tax liabilities, and the depreciation of aging physical assets. It presents a totally distorted reality. For a capital-intensive business, ignoring depreciation is like ignoring the very real cost of replacing your broken equipment just to keep the lights on. A business can sit there boasting about an improving EBITDA margin while simultaneously facing crippling debt or a severe cash burn that is just completely hidden from the headline. Let's look at part three, buybacks and stock splits. So, when a company uses excess cash, or honestly worse, takes on new debt, to buy back its own shares, the total number of outstanding shares shrinks in the market. Mathematically, this artificially inflates the earnings per share, or EPS. Think of it like this. If a company earns $100 across 10 shares, the EPS is $10. But buy back 5 of those shares, and suddenly the EPS doubles to $20. And they didn't even earn a single extra cent in actual profit. The actual net profit hasn't moved an inch, but man, that per-share headline looks drastically stronger. It acts as this short-term stock support mechanism, and it's very often used to trigger executive bonus thresholds that are tied directly to those EPS targets. But this financial engineering can severely mask a dangerous lack of capital being reinvested into future growth or R&D. And stock splits? They operate on a very similar kind of psychological engineering. The total intrinsic value of the business does not increase by a single fraction. Look at the math. One share at $100 holds the exact same mathematical weight, equity, and voting power as 5 shares at $20. It's the exact same pie, just sliced into more pieces. As the saying goes, a stock split changes perception far more than intrinsic value. A lower nominal share price just visually looks cheaper, and it improves liquidity, which is specifically engineered to attract retail participation. You see, everyday investors routinely mistake a split for a real discount, and that fuels hype and speculative trading, which, conveniently, often provides great exit points for early institutional investors. Which brings us to part 4, dividends and one-time gains. Now, dividends naturally project this really shareholder-friendly image of maturity and reliable, steady cash flow. However, a highly inflated dividend yield is very often a severe warning sign. It can signal a structural growth limitation. Basically, it indicates the business can no longer find profitable avenues to reinvest and compound that capital internally, so they're forced to just hand out cash to prevent a mass exodus of their institutional capital. And then there are exceptional accounting gains. Corporations routinely leverage one-time asset sales, temporary tax credits, or maybe non-recurring legal settlements to artificially pump up their headline net income for one specific quarter. This adjusted, inflated figure masks declining core operational performance. At the end of the day, the only metric that actually matters is sustainability. You have to identify exactly which portion of that profit is actually going to repeat next year.
Finally, part 5, what smart investors analyze.
If headlines are just PR, how do you find the truth? Well, rather than trusting quarterly narratives, forensic analysis relies on unmanipulated metrics. True financial health is measured through cash flow statements, where you track the actual movement of liquidity rather than just paper accounting profits. You need to analyze return on equity, or ROE, and return on capital employed to gauge how efficient management actually is with their capital over time. It means scrutinizing debt maturity schedules and promoter share pledging. Basically, it's about focusing entirely on cold, hard business reality rather than the manufactured corporate presentation.
So the ultimate question is, are you reacting to business reality or just corporate storytelling? As we've seen today, the modern stock market is essentially a masterclass in narrative engineering, psychology, and legal manipulation. These practices are totally permitted, but understanding how they weaponize market sentiment is literally your only defense. So before you deploy your capital based on the next euphoric headline, ask yourself one simple question. What exactly is this balance sheet hiding?